Hey, it's been looking pretty good, and today the major indices broke even and are now positive year to date. Let's talk about what's going on and let's go through the order that I've read it all. So, in the start of the day, we were getting some economic growth kind of talk. We got the Organization for Economic Cooperation and Development come out and they were talking, and they said the world economy would lose pace this year. That was their forecast they're seeing. And they're saying that this is stemming mainly from the whipsawing of US trade policy. Now, they say that further increases to trade barriers would dampen growth even more. So, do we think the worst of all of the tariff mess is behind us, or are we just getting started? Let's think about it. How can we get more? Trade barriers, right? Well, let's start off with trade wars and a lot of back and forth and tension rising in the room. It's getting kind of hot. We got China accusing the US of not playing fair to their truce agreements. We got the European Union threat of them issuing reciprocal tariffs on us, and that's one of our largest trading partners. So the OECD, it stands for, urges governments to strike deals to really avoid a sharper slowdown as slower growth and less trade hits incomes and slows job growth. The White House has asked countries to submit trade offers by this Wednesday, so that's tomorrow, 6/4, June 4th, 2025. The global economy is expected to grow by 2.9% this and next year, and that's from the 3.3% that we seen last year. So they're expecting slower growth. The US economy may be the worst of the hit, with growth forecasted for only 1.6% this year due to all of the stuff that we've been talking about. Trump tariffs, which push the inflation rate, which could push the inflation rate up closer to 4%, some believe. Wider policy uncertainty. We got this big, beautiful bill that they're talking about, which could really raise the national deficit. Elon Musk is still calling it an abomination and really disagrees with it. Lower net immigration here in the US and cuts to the federal workforces, maybe implemented by DOGE, the Department of Governmental Efficiency. All of this is down from 2.8% last year. So they're really expecting the US to slow down. Now, the 1.6% that we're forecasting, well, the expectations before for this year were 2.2. So you see the drop. Now, let's talk about inflation because that's really where the tariffs are driving problems, right? Let's put it back on the stock screen. We like looking at the stocks. Tariffs are driving this train of uncertainty, and there's really a divide between whether or not they'll result in this one time price increase, or is it back to inflation increasing longer term and then the Fed having to do more to fight, right? There's already the assumption that we may see a surge of inflation, mainly in the CPI and PCE reports leading into the summer months, which are right around the corner. We're right there. But some are beginning to question whether this increase will be temporary at all, or like is it a one-time thing, or will it last a little bit, or is this going to be the next year's fight, is really where we're getting. So we got some Fed speakers out today. We got Lisa Cook, Fed Governor Lisa Cook, and she sees raising tariff, inflation, and complicating rate policy being a trouble right now. She says, I do not express views of the administration's policies, but I do study the economic implications, which appear to be increasing the likelihood of both higher inflation and labor market cooling. And then she goes off and says that I see the U.S. economy as still being in a solid position, but heightened uncertainty poses risks to both price stability and unemployment. She said, when making decisions, I think it has been valuable to remain a student of economic history. Our recent past has provided some useful lessons for decision making during periods of high uncertainty and elevated risk to our dual mandate goals. So she's seeing inflation still being a worry and sticking around for a little bit, right? Well, that's interesting because we also got Raphael Bostic out talking. And he goes on and talks about how the textbook notion about tariffs is that tariffs get applied once and everybody understands what they are, but that's not the case in this environment we've had over the last several months. And so there's really this question about how people will respond to this, to take on board a rollout that extends over a protracted period of time. Bostic's concern is that if the firms and households of the US start expecting continuous tariff adjustments, and we're here this one day and then we're here this one day and then it's completely different, a lot of flip-flopping going around, that this could lead to more persistent inflationary expectations, which leads to inflation expectations leads to almost a self-fulfillment, so inflationary pressures in the meantime. Now, what's this mean? Well, one, Fed Bostic sees one rate cut versus what the market is expecting, two rate cuts this year. And two, what the Fed's really saying is, hey, we're fine still waiting and seeing. It's still cloudy in this room. And Joel, honestly, and Joel's YouTube viewers, I like, we can't see through this fog, so we're not going to make any forecasts. But as far as rate cuts, we're good, fam. Maybe one, y'all might get one. But let's see how these summer months inflation reports start reading and how the job market's holding up and whether or not this inflation becomes sticky and starts being persistent and showing up in all of the reports, or if this is just a one-off. Now, on the other hand, this tariff mess and inflation, that could be something scary, like a boogeyman in the room, but there is good news. We got a report, a note from Douche Bank analysts, and what they think is that stocks got some decent growth ahead that they could look forward to later on in this year, despite expecting US growth for the year to come in at 1.5%, shy of OECD's forecast of 1.6%. So they see the U.S. expected to grow a little less than the Oklahoma, I live in Oklahoma. The Organization of Economic Cooperations and Developments, I believe is what it stood for. They're coming in a little bit lower as far as their economic growth forecasts. So they think the U.S. is going to grow a little bit slower than them, but they still see some upside to stocks. And they mentioned that company earnings should look a little bit better than expected due to Trump backtracking on some of his tariffs that we were expecting. Like, it was really tough for a little bit, and then he kind of chickened out. So it goes to that Trump always chickens out trade, and it seems to be pretty right if anybody bought that dip. And you're up pretty good after that. It didn't last very long at all. In addition to the ruling from the U.S. Court of International Trade that those tariffs weren't even allowed in the first place, bringing the overall effective rate of tariff levies below 10%. And what they're saying is that this could really help support earnings because we were expecting earnings to be more impacted from these tariffs, and now like they're going to be significantly less due to Trump backtracking or even away period. Companies might perform better than analysts were expecting, so beats are usually good news, right? Now, in addition to lower tariffs helping earnings look better, more support for the stock market would be coming from an estimated 1.1 trillion in company stock buybacks that are expected to happen this year. Now, that's great support, but they do say that this rally they're expecting in the second half of the year will not be absent of significant volatility, they go on to note. Now, market breadth has significantly improved, and this is doing really good as far as just another fear gauge to consider. When less companies are moving up, and then let's say the entire index is moving up or the entire indice is moving up or whatnot, and only like 3 companies are really carrying that growth, and all of the other ones are going down and are in the red rather than green, that's not seen as a healthy rally or a sustainable rally or move or direction signal. Now, right now, that market breadth for the S&P 500 is around 60% of stocks being in this uptrend. So 60% of the stocks are moving up, 40% are moving down. Of course, it's going to be a little different based on the day and the very minute you're looking, but that's about where we're at. Now, there is another reason to kind of expect some type of gloominess out there, and this is coming from one of the largest asset managers out there with $10 trillion in assets under management, and they're in the spotlight right now. This is going to be BlackRock. And what they're bearish of right now are US bonds. And there are many different concerns right now, but mainly around the US national deficit and then these inflation risks that keep on coming up, all adding upward pressure on top of these longer term treasury yields. So let's think about all of this stuff we got in the room right now. We got Moody's downgrading US credit. We got number 2, we got trade deal uncertainty, and think about what's going on with China and the European Union, and then maybe even others down the road. These talks are still going on. We don't know where we could go from here. Then we got trade disputes with countries that buy. Now, like, we're having a problem right now. Like, let's imagine we're friends and you got this store and we're in an argument, and I usually go there and buy my pack of gum and I really like you. I might not go to your store during the argument to load up on gum, right? I might buy less gum. I might only stop by once a month rather than every week or something. So that's something to just consider. And then think about the carry trade, the Japanese yen carry trade, where Japanese yields risen and bond prices went down, and it called like almost a margin call effect. It looked at a Japanese carry trade, and we covered it in some videos. Now, number 4, one big beautiful bill. So the national deficit increasing, that was one of their worries. And then stocks looking juicy. So let all of this just competes for US US yields compete against stocks and other assets. And then on top of that, all of this other stuff that increases the pressure of yields going up, leading to BlackRock to look at other countries like the European Union, Central Bank, and Bank of England for other alternatives. And this was right as Jamie Dimon is warning that the bond market could crack and that this could happen soon. He's not for sure, but he thinks something's coming, and he's watching the bond market. And with the bond market being the front of the show right now, these longer term treasury yields are really high. What does that really mean? Well, treasury yields directly impact borrowing costs. And with borrowing costs being higher right now, that just goes back to everything we're watching. Now, one of the main things that everybody's watching, so think about it, bond yields are in the spotlight, and bond yields impact borrowing costs. And who borrows? Well, people do. And if people need to borrow money, they need to pay it back, right? They need money. Well, what are one of the ways they make money? Jobs. We got a jobs opening report today. And what we've seen is that job openings rose in April despite the mess of tariffs that we've seen, and some would describe this environment we're in as one of the worst trade wars since the 1930s. Well, new job postings they rose to 7.4 million versus the 7.1 that were expected. And this accounts through the end of April. And what we seen through the end of March was 7.2 million. So we went up 0.2 million to 7.4. We seen the rate of hiring, which is still at a post-pandemic low. Oh wait, I didn't. Oh, wait. Yeah, so the rate of hiring's at a pandemic low. Where's that at on here? Missed it. Number. Yeah, there we go. The rates of hires were little change at 5.6 mil and 3.5%. We also seen the quits rate still hovering around 2%, so little change there. Less people are leaving their jobs, so that could be seen as, gloomy for the environment because people are more likely to stay at their job when they don't think they can leave and get a better job or that they'll get hired fast. And that does go in to show that businesses are taking the Fed's approach, this wait and see, we'll wait before really scaling and moving some weight, so to say, with investments. And think about investments as resources they use, like a laptop and Wi-Fi and equipment to work with, and then inventory, and then space. You need land and a building and all of this other stuff that goes into it. They make less investments during times of uncertainty, so they're not really scaling back. We're not seeing a ton of layoffs because layoffs are still extremely low right now, but they are scaling back on hiring or on investments and hiring. So that goes in sync with the quits rate still hovering around the 2%. Now, what everybody's going to be watching is this employment report that we got coming out on Friday. That's going to give us some more index into how jobs are holding up and unemployment, and everybody's watching this one. A lot of more bearish people in the industry are thinking that's where we get our first scary job report. And then if we got a scary job report and then inflation started rising again, and people's expecting slower growth here in the US, what's the definition of stagflation again? Now, what we also seen is that Dollar General shares zip higher after the retailer raises their outlook. So Dollar General raises full year sales outlook after better than expected earnings first quarter results. The discount retailer expects sales to rise 3.7% to 4.7%, and the same store sales to grow 1.5% to 2.5%. This is interesting just considering that, because Dollar General, like, I'm not going to say it's like the low of the low, but it's pretty low down there on where where shoppers are shopping for cheaper goods. Like Walmart, everyday low prices, but Walmart, like, it's kind of high these days. And Dollar General, it's in its name. So if they're expecting sales to really rise like a percent this year, they're expecting more people to shop there, and that could just go into show what we seen with. Matter of fact, going back to the job openings thing we just seen, job listings fell for hotels and restaurants. So more people are dining in at home and more people are buying the more cheaper alternative. Now, this is just more data giving us insight into the consumer. So more Dollar General is expecting more people to shop at Dollar General for cheaper stuff. So what does that tell you about the consumer once again? And also, just to mention, back to the jobs postings, we've seen job postings increase for more your white collar jobs, retail, healthcare, entertainment, recreation. I thought the hotels listings falling along with the restaurants, more so restaurants, like everybody eats at restaurants, but hotels, unless people are traveling, they're usually not getting a hotel on a regular basis. So hotels could tell us quite a bit about people traveling to the US. And when you go back to this trade war and everybody's mad at everybody and borrowing costs are high and the OECD's expecting that the global economic growth will come in a little bit slower this year, it all just kind of like lines up and adds up to each other. Now, just real quick, let's see what the CME Fed Watch tool is looking like after Lisa Cook and Raphael Bostic came out and we're talking. So we don't really care about June. Yeah, 98% is where they're at on that. September 17th, I mean, it's still holding up. They're still thinking a cut in September. And that's after that June and July. So we get couple CPI reports and PCE reports between now and then, and they're expecting CPI and PCE to come in higher in the summer months. But Lisa Cook and Raphael Bostic are hinting that, hey, it might be a little bit longer than just these summer months than a lot of people's expecting. What if it lasted until like December or January or something? That'll put us at a different spot as far as cutting rates and what we think we should do. And we're like, the job market's still holding up pretty good. Watch Friday. But so far that's looking good. So people still have money. I mean, yeah, they got to go shop at dollar store to afford their stuff, but I mean, they still got their jobs, they're still spending, they're saving. So we're cool just waiting. So y'all, that's what I got today so far. The market's still open. It's only 2 p.m. Central Time where I'm at. But had some time to make a video a little bit earlier, and hope it was valuable for you. Y'all have a blast.